We start with, hey, welcome to Spin Out, winner Dave, and we kind
I'm
of
winner.
All right, we're here to demystify venture, minimizing FOMO for VCs through the relationship that we'll talk about between GPs and LPs.
In this new series, we're focusing on how LPs assess GPs and how you as a GP can differentiate yourself. Last week, we dove into terms, fund formation, and everything you need to talk to your legal counsel about.
And today we're going to dive into risk management. But before getting too far, let's do a quick review of the series that we've covered and some of the episodes that have come out so far. So first episode was just an introduction, but we've talked about team, we've talked about alignment, we've talked about track record, investment strategy, and process around investments. And last week we talked about fund formation and terms. Today's topic is risk management and governance. In today's conversation, we're going to break down risk management, which is one of my specialties, into a couple of big risk buckets. Then we're going to talk through how GPs leverage their governance structures to manage that risk. They do go together. So, Winner, why don't you kind of walk us through the first risk framework?
Thanks, Dave. So this topic, risk management and governance, could be very convoluted, very hard to even understand what we're talking about. So what we wanted to do is first provide you with a couple of very simple frameworks, which will apply throughout the episode. So the first framework is, and this should relieve everyone of a lot of stress, is what can you control and what can't you control? You can control the processes you create. You can control the investments you make, how you make those investments. You can control how you build your business. And there are other things you can't control, right? Such as macroeconomic factors. So today, we're going to talk about what you can control from a risk management and governance perspective. And we're just going to kind of forget about it if it's not in our control. Dave, you have a very unique perspective here on risk management. Can you introduce kind of your background here and what the second framework is?
Yeah, absolutely. So, prior to my career as a CFO in venture, I was an Army officer. And principally, one of the jobs of an Army officer is to manage risk. Because as you can imagine, it's a very rough and tumble life. And one of the jobs, particularly that I had, was teaching people to jump out of airplanes, which is a very risk filled job. And so we use this framework that I'm going to lay out to help us think through all parts of that training and then ultimately jumping out of a plane. Right. And so this framework can be used for very simple administrative things, and it can be used for very complex, highly sensitive areas as well. And so the framework is how you take an event or some sort of risk and you want to understand how likely it is to happen versus unlikely. So you build a little chart that kind of has likelihood on one axis with an event being very likely to happen at the top and very unlikely to happen at the bottom. And then on the other axis, you want to think about whether an event is kind of got a minimal impact on you or your business or your investments, or it has a catastrophic impact on you, your business, or your investments. And so when you put these two axes together, you get a very clear chart that lays out the likelihood of an event to happen and then how catastrophic it will be. And what you would imagine is if an event is highly catastrophic and very likely, that would be your top priority risk to mitigate. And so as we talk through all of these risks, one of the key things that you'd want to do in your risk management is actually build out this simple framework. How likely is something to happen and how catastrophic would it be if it were to happen? And then that'll help you prioritize which risks you want to start mitigating first.
So let's jump into the three risks we're going to talk about today. We have investment risk. We have investment management risk, right? So for example, building out your portfolio construction, or your investment policy discipline. And then we're going to talk about business and structural risk. We'll go into what we mean by that. So Dave, maybe introduce us to investment risk. What are we even talking about here?
Yeah. So when I think about investment risk, I think of it from the LP's point of view as well. And so there are a couple ways that LPs and GPs can kind of think about the investment risk that they're kind of taking on together. And usually you see these things written down in LPAs and side letters. So it's very kind of structured in what is actually expected here. And so in LPAs and side letters, what you'll often see, what is kind of market and my experience today, is you may see caps on concentration. So how much of the fund's assets can be invested into one particular company or maybe into a particular geography or industry or sector. That is meant to kind of force a certain amount of diversification. You might also see limits on what types of assets can be purchased, right? Because if you're an exempt reporting advisor, non-qualifying investments would actually kind of potentially be very very damaging to your exempt reporting advisor status and force you to do other things, right? So there may be these structural limits that are imposed that are to your own benefit, but also just clearly lay out the expectations between GPs and LPs of what types of things you'll be investing in. And I would say the last one that I normally see a lot of documented kind of risk management control is around leverage in the venture fund. So how can the GP or how can the fund itself take on loans like lines of credit, capital call lines of credit, or GP lines of credit? And then how is that debt managed and paid back? How much of the fund's assets can be levered? All of those things are usually kind of very clearly articulated in LPAs or in side letters.
I want to apply your framework to investment risk. So again, just as a reminder, right, we have likely versus non-likely, catastrophic versus minimal impact. And so from the LP perspective, right, I'm applying Dave's framework to investment risk. Where I want that investment risk to sit is, right, non-likely and minimal adverse effect, right? I want to limit the likelihood of you putting all of the money into one investment, for example, right? Or I want to minimize the impact of you taking out significant leverage on the venture fund, right? So again, GPs can use this framework, right, to kind of figure out, the impact of their business, but LPs also use this framework because again, they're trying to, with the structure of the LPA, for example, or the structure of these side letters, minimize the actual risk that they're taking on and structurally prevent some of those risks from even happening. Moving on to investment management risk, which is the second risk for today. Dave, maybe apply your framework, walk us through and apply your framework to investment management risk and, what GPs should be thinking about when they're thinking about investment management risk.
Yeah, absolutely. So I think the clearest way to say this is LPs are once bitten, twice shy. And 2021, 2022 loom very large in everyone's mind still. And so what you see in portfolio construction is a lot more focus on things like time diversification or sector industry diversification, rules or some sort of structure or guidelines around check sizing and ownership targets. And all of that is meant to help prevent what would be if you didn't watch it, a likely outcome, a catastrophic would be either spending too much of the fund's capital too quickly and then going back to your LP base. That causes problems for your LPs who may have their own cash flow planning, right? So an event where you're doing something that's unexpected for everyone else can cause quite a bit of downstream risk for both you and the LP.
From the LP perspective, I believe LPs are trying to answer the question relative to other asset classes where I could invest my money. Can I confidently invest my money into this venture portfolio and believe that it's going to, more often than not, or with a high likelihood and a high probability, outperform and generate great returns? And if you can't get to that answer for that question, I think you're potentially mismanaging your, how you're building out your portfolio.
Yeah, absolutely. I mean, some of the last couple of years, some of the bigger issues that I've seen when this falls apart and people aren't keeping an eye on managing these risks is you call too quickly and you overinvest too early. And then you run the risk of either not being able to pay management fees or not to be able to pay your key service providers and vendors in the out years. And that causes all kinds of complications and heartache. And so, there are very real implications to you deviating from these risk controls that you set up to help you actually, build this portfolio.
Yeah, I think as a GP, you're trying to get as many investable dollars into opportunities as possible, right? And you're trying to give your portfolio the best opportunity to perform well, right? So there's a lot of factors kind of going into this investment management risk. Transitioning to business and structural risk. Dave, walk us through kind of what could potentially impact our business as a GP when we're building it out in the beginning.
Yeah, and I would say this one's also unique in the investment risk and investment management risk. There are kind of market expectations. There are mentors and legal advisors and accountants that can help you kind of get to what is kind of a lower risk, higher reward type outcome there. Business and structural risk is a little bit more self-defined, and it is kind of idiosyncratic to the individual set of GPs and the businesses they're running. And so what I'd highly recommend everybody do is actually build out the risk management kind of worksheet, this framework of likelihood on one axis and catastrophic nature on the other, and then start plotting out where these different types of events might actually end up. And so with business or structural risk, what we're really thinking about is things like disaster and continuity planning, thinking about platform risk and your service providers. They're critical to your business operations, and losing a service provider at the wrong time can create a tremendous amount of operational debt that distracts you from investing. Then you also have key man risk, both employees and investors. Everybody's usually a small team, and so losing one of your 5 employees can be very dramatic in a short time frame. And then the last risk that I think about in terms of business and structural is around the long-term thinking, succession planning, and partnership risk. So those are some of the bigger ones that I think fall into this bucket, but obviously there's a lot of different individual risks inside of it and then ways to mitigate that risk.
I think from the LP perspective, there's another risk, right? It's a risk to your business if you're too concentrated. If you have a single LP, what if that LP left? What if that LP has too much influence over your business, right? Are other LPs investing into you, the GP, or are they investing into this LP that has a lot of influence over you? So I think as you're building your business as a GP, as you're scaling your business, as you go from fund 1 to fund 2 to fund 3, again, making sure you're having those active conversations, you're bringing in new LPs. No LP has, too much concentration in a single fund, because again, if you lost that relationship or you lost that investor fund over fund, that subjects your firm to a lot of business risk.
So we've talked the first half of this about the risks. The key part of risk is risk management or risk mitigation. And so let's talk about how governance can help fill that role of mitigating or managing some of these risks. And so, Winner, what are some of the kind of key things that we think about when GPs are starting to put together a governance plan?
We'll talk about maybe 4 or so things here. So the first, we've touched on it, the LPA, right? The LPA effectively is the contract between you, the GP, and your LPs, and it governs your behavior, right? It puts kind of restrictions and guidelines around your behavior. And it also kind of puts structure to your portfolio. Again, we just talked about, caps and other kind of elements that will be part of the LPA. So from a governance perspective, you have a contract that you need to be compliant with, right? And so I think the focus there should just be making sure you know what's in your LPA, you know what's expected by the people you've engaged in that relationship with, your LPs, and you're compliant with that contract. Secondly, I think there's the element of side letters, right? So these contracts you have beyond the LPA, beyond kind of the core legal document. Again, when it comes to side letters, after you've fully kind of like closed your fund, compliance. So a best practice here would be like a side letter compendium, where you take all the different terms from all the different side letters and you organize them into one sheet, into one document, and you make sure you follow those terms, right? Because those are ad hoc, idiosyncratic terms with respect to usually a specific LP. And you just want to make sure you're compliant there. So again, it's a matter, it really comes down to like simplifying it, but LPA and side letters are 2 things that you're really going to have to govern. And I think the way to govern it very simply is to make sure you're just well organized.
The risk really here is breaking trust, right? Like if you're in breach of a contract, that breaks trust with your LPs. And many institutional investors take this very, very seriously because they're invested in a lot of managers. They need to believe that they can trust you. And so if you start violating some of these things, even if they seem small or unimportant to you, just remember LPs do care about them. That's why they're in these written documents.
So I think another kind of tactical way to govern is to have some sort of advisory body. This is typically the limited partner LPAC. Dave, you want to quickly just define an LPAC for the audience and maybe go into, why this body is potentially important for a GP?
An LPAC is an LP advisory committee. They often serve not in a board role like you would think of in a C Corp, but a much more advisory role. And usually an LPAC is made up of a smaller subset of your LPs. It's not every LP, but you would think of it similar to a board structure, right? So you'd want 3 to 5 LPs. Usually this is a role that an LP would ask for or want to take because they're a large investor in the fund and they want to be able to be involved and have more interaction with the managers. It may also be specific to certain parts of that investment management or investment risk, where we're talking about the LPAC having some sort of consent to change things in the LPA or to extend or, alter or amend the LPA. And so there's lots of different things that it can do, but it is an advisory committee that the GPs put together, and they use that committee to kind of get advice or to check with the LP base to ensure that everyone's going to go along with a particular decision. Or, sometimes your LPAC can represent enough of the LPs to actually vote, so to speak, on some of these changes. Your LPAC can be a faster way to reach consensus among your LPs, depending on how you're concentrated among that base. Did I miss anything, Winter?
I think the big picture here is your intention as a GP, right, to Dave's point, is to, manage trust and not breach that trust with your LPs. And so, LPAC is one of the few tools you can use for governance, right? Especially if you're a solo GP, to have an outside party that, should be helping guide you, right? And helping you think through some of these potential conflicts of interest, right? The intention can be there, but you're still going to run into some tough decisions. So again, having a kind of, third party body to help guide you through, some of those tougher decisions is important. Lastly, just kind of, wrapping up here, what you build as a GP, right? The rituals you instill into your culture, into your business, the standard operating procedures you have, like what you build here, again, to make sure you're properly managing and accounting for risk, to make sure you're governing the business well, the checklist you create, right? Super important for, I know Dave, super important for me, should be super important for everyone, right? And coming at it from the LP perspective, right? I know some GPs, if you've gotten to this point, like you're ahead of the curve, like this is amazing. For LPs, this is music to their ears, right? This is music to my ears of, I want to be able to understand what controls you've set up, how you expect to kind of govern your business, right? What your intentions are before I write a check. Because I want confidence that, again, I don't have to handhold you day in, day out to make sure you're doing the right thing. So again, some of this is structural, but some of it is also like behavioral, and making sure like I, as an LP, think this is very important for you to, again, do the right deeds, institutionalize your firm the right way to build the right business and, build a great portfolio that hopefully at the end of the day outperforms. That's what this is all about.
Yeah, couldn't agree more.
Turning our attention to, did you see?
Yeah. I guess the did you see that we should be talking about right now is Carta has recently released their 2025 fund economics report. So I highly encourage everyone to go download it and start going through some of the key findings. And I would expect hopefully the Carta team will continue to publish this data every year. And over time, we'll get to be able to see trends and see differences in how funds are being managed. But one of the couple of the highlights that popped out to us initially was the difference between private equity funds and VC funds in terms of GP commitments. I think there's some interesting data around how quickly funds are calling capital and what percentage of that capital is being used for fund expenses compared to investment. And then the pacing, I think, is also important. So understanding where your fund is in your life cycle relative to the others in terms of how many dollars have been deployed and what that breakdown is between investments and funds, fees and expenses. But what I will say is, as you're reading it, be very careful to the designations, the categories, the groupings inside the data, because, for instance, an expense load on top of a $50 million fund versus a $100 million fund is dramatically different. And so if they're in one category, just pay attention to that, because what you want to try to do is figure out what's right for you and your business, but helping to see what everybody else is doing is really powerful. So I highly encourage everyone to download the Carta Fund Economics report and read through it.
Yeah, it's very insightful. I'm surprised. I see 1% a lot of the time in the VC world. Seeing a median of 1.7% is actually surprising. And I think that's trending in the right direction. So very interesting, Dan.
And it could be just anecdotally, in my experience, I've seen a lot more GPs using cashless commits as a way of increasing their GP stake by using their management fees to increase the amount of investable capital, and then therefore over time earning that sweat equity. And so I think that could help increase the amount of GP skin in the game in a way that still allows the emerging managers to have enough cash to set the business up and to actually get the first investments out the door. So yeah, hopefully all positive things.
I've seen another mechanism as well, like over the last couple of years. So think of that. If you started your fund in 2020 through 2023 and you're coming back to market, I've seen a lot of those fund managers actually do kind of a GP commit in kind from some prior investments. And that's even happening with a couple of funds, we're working with right now, which is another way, again, to increase your GP commitment without necessarily it having to be kind of all cash. And again, creates better alignment with your LPs, hopefully. And it's a good signal for fundraising.
Yep. Excellent. All
Great.
right. Well,
Thanks,
I
Dave.
guess we'll come back next week. Our next topic is compliance and regulatory. So everyone, please tune in for the compliance and regulatory. You may have just received an email from your regulator. You should double check. And we look forward to seeing you all next time.